Hey there and welcome to our channel. Today we're going to be discussing an important financial question that has been plaguing the minds of many, including myself. Should you pay off your mortgage or invest in the stock market with any extra money you have?
That's a good question.
But before we dive into that, let's take a moment to appreciate the fact that we're even discussing this question. Because we're discussing it, it means you have extra money to spare, and that's something to be celebrated. Or maybe you're just curious what the math looked like.
Told you guys curiosity killed the cat.
Anyway, if you are new here, please do me a favor and subscribe to our channel. It really does mean a lot. I mean, it's free, so why not?
I do love free.
Go ahead, do it.
Okay.
Anyway, back to the video at hand. I wanted to discuss why someone might be interested in paying their house off over investing in the first place.
I wonder why.
Some reasons could include the desire for a stable long-term investment, the desire to own property and have a place to call their own, or the belief that the value of the property will increase over time and result in a profitable sale.
Real estate.
There could also be tax benefits to owning a home that an individual might not receive from other types of investments.
All the information, including tax benefits, is in here.
Ultimately, the decision to pay extra on a house or invest the money will depend on an individual's personal financial goals and their priorities.
At least you got your priorities straight.
Now, to help you make a decision, we're going to provide an in-depth example of what could happen if you invested $1,000 a month or you paid down your mortgage by $1,000 a month over the course of 20 years.
How many years? How many?
We are talking about a 20-year time period.
Yes, 20 years.
First, let's look at paying off your mortgage. If you have a 30-year mortgage with an interest rate of, let's say, 4% and a remaining balance of $200,000, and you pay an extra $1,000 a month towards it, you would pay off the mortgage in around 13 years and 8 months.
Pretty quickly, yes.
This would save you around $84,000 in interest payments over the 20-year period. Nice chunk of change, if I could say so myself. This would also increase your net worth by the amount of your mortgage balance, which would be $200,000 in this case, and obviously that could go up if the home value goes up, which it tends to do over time.
Yeah, that's usually the way it goes.
However, it is important to keep in mind that you would also be tying up a large chunk of your money in a single asset, which would be your home. But hey, at least you'll have a roof over your head and a place to call your own.
Sweet home.
And then after paying off the mortgage, you would be able to invest an additional $1,000 a month for another 6 years and 4 months since you didn't get to 20 years yet.
I like that.
Assuming an average annual return of 7%, you would have invested around $78,000.
Give or take.
To recap that situation, you would outright own a $200,000 home, which we would assume would be more after 20 years, plus you would have saved $84,000, so we can add that to the total, and you would have roughly $78,000 invested. Now remember, we are not getting into taxes involved, but that would definitely play a role in it as well.
State tax, federal tax, social security tax.
Now, let's consider investing $1,000 a month in the stock market. If we assume an average annual return of 7% for the S&P 500 over the past 20 years, your investment would be worth around $522,000 after 20 years, and you would still roughly have $121,000 in principal left on your loan.
Is a chunk of change, huh?
This is significantly more than the savings from paying off your mortgage, as you would be able to see a net worth of $522,000 minus $121,000, which would be $401,000 if you then paid it off, compared to roughly $278,000. But it's important to note that past performance is not indicative of future results, and the stock market and housing market does not come with their own risks, such as market volatility.
Yeah, it's so bumpy.
But let's be real, the stock market is like a roller coaster ride. It has its ups and downs, but it's always an exciting ride.
It goes up, it goes down.
It is, however, important to consider that while the stock market has the potential to grow your wealth significantly more, it also comes with more risk and volatility compared to paying off your mortgage, which guarantees an increase in net worth and savings on interest payments.
Guaranteed!
It's also worth considering that a mortgage is a long-term debt and it may take a while to pay it off, while the stock market is a short-term investment with the potential to generate higher returns in a shorter period of time.
That makes sense.
I know that was a lot to wrap your head around, but the decision of whether to pay off your mortgage or invest in the stock market is a personal one that depends on your individual financial situations and your financial goals.
Does an advisor ever ask you what your financial goals are?
Paying off your mortgage would increase your net worth by the amount of your mortgage balance and save you interest payments, but it also ties up a significant amount of money in a single asset.
Put all your eggs in one basket, egghead. A fatal mistake.
Investing in the stock market has the potential to grow your wealth significantly more, but it also comes with more risk and volatility.
There's bound to be a risk on some level.
It is, however, important to consider both options and weigh the pros and the cons before making a decision. It may also be, a good idea to speak with a financial advisor or professional to get personalized advice based on your specific circumstances.
Financial circumstances.
I know before inflation and before things were a little crazy, I was really trying to spend a lot of time putting money into our mortgage, trying to knock it out sooner. And at this point, I really don't have the funds to do that at the moment. And so I've kind of put that on the back burner. And that's fine because I did lock in at a lower interest rate than what interest rates are currently at. And I realized we used a 4% interest rate in this example, which might be higher or lower than what your current interest rate is. But that's just kind of where I thought some good middle ground would be.
I promised you, no middle ground.
Thank you so much for watching. If you found value, please share this video with someone. Give this video a like for the YouTube algo, and I'll see you in the next one as long as you're subscribed.
I subscribe to that.
See you soon.